Now, he's managed to stay a bull through all of this market turmoil. Let's check in with long-term investor Chuck Lieberman of Advisors Capital. Chuck, it's good to have you with us. Thanks for coming in.
Thanks for having me, Pim.
First, I got to just tell you, it is amazing you have managed to stay a bull pretty much throughout this entire financial debacle. What do you take to maintain your equanimity, I guess would be one way to describe it?
Well, it helps having some experience, and losing some hair over the years gives you a little bit of perspective on what's going on. Don't panic. Look at what's going on. Try to figure out what lies ahead. That's the name of the game.
Now, you, in your most recent letter, you've said that, your approach really to certain types of investing has varied throughout this cycle, even though you have been bullish on equities to a certain extent, as well as certain types of fixed income. But now you're giving some details that you might be shifting. Tell us about it.
Well, you have to reflect the temperature of your clients, and our clients, of course, panicked during the bear market. So we had to become a lot more conservative. That led to a whole bunch of different types of strategies. For example, on the fixed income side, where we were looking for fixed income 8 months ago, 9 months ago, we were in high-quality fixed income only and also very short. Several months ago, as the credit market started to improve, we went into more risky credits, not into really deep junk, but into, let's say, triple Bs and double Bs.
Is this because of the yield?
Because of the yield. We wanted to lock up those kind of yields, and we wanted to do it for a long time. So we shifted from high-quality short into long-term, and what I would describe as middle quality.
Is that over now, do you think?
Yeah, we're over that one. We're actually selling some of those pieces of paper out and actually taking a little bit less yield and going into busted convertibles as for our fixed income clients.
So maybe even taking on a little bit more risk in certain areas?
Right. We want the upside. And so the convertibles can provide that. If you get a busted convert in a company that you follow, that you know pretty well, that you think can recover, then that gives you plenty of upside. And, of course, in the meantime, you have a nice coupon to clip.
What about the Treasury market right now? Would you be advising people to stay away?
As far as possible.
As far as possible?
Maybe the next continent or something. Treasuries are really unattractive. Basically, lots of risk, very little return. You'll get your money back, but whether you'll get it back in real terms or nominal terms, you'll get it back in nominal terms, not necessarily in real, and the return will be actually pretty minimal compared to most everything else. So
Do I hear a hint of inflation, perhaps?
A little bit, but not necessarily a lot. And I think it's premature to have any judgment whatsoever on inflation. That depends on policy mistakes that have yet to be made.
New policy mistakes. What about the GDP numbers that came out today, the revisions for the first quarter? And what's your outlook? I mean, is there a correlation between what GDP does and also what the stock market does?
Well, there's definitely a correlation between GDP and the stock market. The stock market is trying to anticipate GDP, and the stock market thinks that a recovery is coming, and we agree. In terms of the GDP numbers, they changed history. The recession was a lot deeper, but the outlook for the immediate future is brighter. The inventory numbers are so deep that there's got to be a very substantial pickup in manufacturing just to stop the inventory liquidation.
So you got to actually create all that production just to fill the shelves up again?
Just to stop liquidating the shelves. Not even to refill them, just to stop liquidating the shelves. There's got to be over $140 billion worth of increase in production. That's sizable.
All right, what about the housing market? Are we going to see any production there, or are we just going to see more sales from foreclosures?
Well, that's what a way to put it.
I'll give you a bigger choice. The second half of the year, what's it going to look like in housing?
We're going to see housing go from a big drag on the economy, which it was in the second quarter, even though housing starts in the second quarter were higher than in the first quarter, because it takes a while before the start translates into meaningful expenditures in construction. And so over the next 3 months or so, we're going to see housing expenditures for construction take a big pickup, and we're going to see housing before the end of the year be a contributor to growth instead of a drag. And in the second quarter, it was a large drag yet again.
All right, we're going to continue the conversation. We're going to have more with Chuck Lieberman of Advisors Capital. We're going to find out, well, what about allocating some new capital? Where should you put it? What about the housing industry and housing stocks? We'll find out. This is Taking Stock on Bloomberg. And a programming note, Taking Stock begins each weekday at 3 p.m. Eastern on Bloomberg, 1130 a.m., XM Channel 129, Sirius Channel 130, and yes, on Bloomberg.com. This is Taking Stock on Bloomberg. I'm Pim Hawks. If you're just joining us, we're talking about the long-term view of investing. My guest is Chuck Lieberman of Advisors Capital. So, Chuck, you take the long view, but right now, what if you've got new money to allocate to the market? Would you be going into, let's say, housing stocks, for example?
Yeah, there are a lot of housing-related stocks that we do like in the home builders sector. We like NVR, which is one of the financially strongest companies in that industry. I think you'll make more in some of the other stocks, but they're also a lot riskier. And then there are lots of suppliers to the housing industry that we think are fabulous investments. One of the companies that we really like is a company called Trex. They make the composite decking material. Fabulous company. They'll make a couple of bucks a share, a couple of years out. Stock is very cheap, around 16 bucks, tremendous value. Masco, kitchen cabinets, another terrific company. The stock has really been doing fabulously in the last couple of months, but I think there's a lot more to go. And then, of course, the classics, Home Depot and Lowe's, both terrific companies.
You know, and just to kind of backtrack slightly, you know, during the break we were talking about sort of the investor mindset. And how difficult is it, from your perspective, to get the investor to stop investing, let's say, using the rearview mirror and start looking forward? Because I would imagine this is a real challenge, because when the market hit those March 9th lows, I mean, no one really knew where the market was going. So to be fair, someone calling up and saying, look, Chuck, I just can't take this anymore. How do you respond to something like that? What do you do?
Well, it's very difficult. We manage all of our client money as separate accounts. So we manage each client's account separately, and they have their own portfolio. And their risk tolerance is cyclically sensitive, shall we say. So when the market goes down, they become very concerned, some of them more so than others. If they really can handle it, then we encourage them to get into fixed income, build some cash, do some of the things that they need to do in order to sleep better at night. It's just necessary for their own survival.
Then what about that time frame? Because I started this segment really talking about this notion that, you know, buy and hold and just put it away and don't look at it. It's kind of gone, it seems. Now you've got to watch things, but you may still hold things for quite a period of time. Well, how do you build those kind of long-term positions?
Well, we're long-term oriented, and the critical piece is having the client understand that short-term fluctuations in the market ought to be ignored. If the market goes down sharply, that may be a buying opportunity as opposed to a signal to get out. It really depends on the environment. Right now, after what we've been through over the last year or more, it makes sense that if the economy does improve, the stock market is still very, very cheap. All we've done so far is largely reverse the losses of January and February. We're only slightly higher than where we were December 31st of 08. So all of the declines of 08 have not been reversed yet.
Do you think, though, that the market is going to continue at this pace to accelerate?
The easy part of the answer is no, because you put in the phrase "at this pace." This pace is typical of the very, very first stage of a recovery. But from here, the market will be show me, and we'll need evidence of a recovery. I think we're going to get it, but you have to make that judgment and then invest accordingly.
According to some of your investments, you've been looking at master limited partnerships for some income. Why MLPs right now?
Well, they've been great at providers of income. It's really very suitable, almost perfect for clients who need income, especially over the long run. These are investments that have inflation protection built into the structure of the firm. They own tangible assets, and so inflation doesn't hurt them. It actually helps them. Their profitability would rise, and they provide recurring dividend income that gets paid out, or distributions is what it's called, recurring distributions that get paid out to the owners, and that's wonderful for people who are retired living off their portfolio.
So in a sense, maybe replacing some of those lower yielding bonds with MLPs?
They're fabulous alternatives. We prefer them to bonds. Way ahead of bonds, because bonds pay fixed income over a long period of time, which means inflation kills off your income. Whereas with MLPs, inflation is their ally. They actually become more profitable with
the
more
distributions
inflation.
Can be increased.
Distributions can be increased, and in fact are very likely to be increased in a high inflation environment. And so that means their income is maintained relative to inflation. It's wonderful.
All right. Now, what isn't wonderful is what's been going on with the U.S. consumer, at least as you believe people who talk about the personal savings rate, which is increasing, the deterioration in personal credit profiles, and yet you've been shifting, right? You've been taking a look at stocks in the consumer staple sectors, selling some of those, and you've been looking at consumer discretionary stocks.
Right.
What gives you the confidence to do that?
Well, again, 2008 was a terrible year for the economy and the consumer. And the companies that tend to hold up better in that kind of environment are, of course, the consumer staples, because, as people say, you still have to eat in a recession. So those kind of companies hold up well. In a recovery, if your thesis is that there is a recovery underway, any kind of recovery, whether it's a strong recovery or even a weak recovery, then discretionary companies will come back and they'll outperform. And in fact, if you look at the performance for 2009, staples have underperformed the market by a significant amount, and consumer discretionary has outperformed.
What about the consumer in China? I don't want to let you go without finding out your focus on what's going on in China. Is that for the more robust investor, the one willing to take a little bit more risk investing in China?
Yeah, we have Chinese exposure in our growth accounts, our most aggressive investors, the ones who are looking for maximum capital gains, who are not interested in income. And there we have exposure in China. One of our holdings, in fact, one of our largest holdings, is Baidu, which is the Google of China. It's been a fabulous performer for us. We loaded up the boat at between 100 and 125, stocks over 350. In fact, we've actually pared back a little because it's up so much. It's become disproportionately large in these accounts. So we've actually been forced to pare back some.
All right. I want to thank you very much. Chuck Lieberman, coming in from Advisors Capital Management. Very interesting reading in your most recent letter to investors, as well as your insight into the markets. Thank you.